This is obviously the first one, and they are characterized by two differentiating attributes, if you will. The first is that we include speakers with what I would call earned wisdom. These are folks who've been there and done that with the topic of the summit. And speaking of the topics, they're topics of strategic importance to both job boards and talent technology companies. So they're all about enhancing operational excellence and shareholder value or stakeholder value. And we do, as I said, we do them twice a year, and they're normally only open to members of the TAtech network. But we've opened this one to the public because we want everyone to see the caliber of the speakers and the value of the topics that we cover. If you want to take advantage of the summits and all the other benefits of TAtech membership, please stop by tatech.org and click on the participation link, and you'll see how to get involved. These virtual leadership summits are the digital siblings of our in-person leadership summits, which kick off all of our conferences each year. These are the in-person summits are 4-hour events, half-day events that really dive into a topic in much greater detail than we're able to do online. The next in-person leadership is coming up at TAtech North America on May 6th through 8th in Charleston. So I hope if you're available that you'll join us. We're going to cover the topic of evolution. How are organizations best able to evolve in an economy that is transforming itself? So the topic for this virtual leadership summit is exit readiness. Now, if you do a browser search on that topic, you're going to find hundreds, maybe even thousands of opinions about how best to prepare for an exit. But they all seem to have a similar or the same theme. And one writer put it this way: while the exit may seem like a distant event, making exit readiness central to your business strategy offers benefits at every stage, not just when you're looking to sell or transition leadership. So my panel of experts are going to parse that view and add their own. And I'd like to welcome all of the speakers to the stage. I'm going to ask them to introduce themselves, but we have AJ Richichi, Mark Simpson, and Sarah White. We hope that our fourth speaker, Georgios Markakis, will be able to join us during the show. So let's start with introductions. Sarah, would you please tell us a little bit about yourself and your organization?
Absolutely. My name is Sarah White. I am an independent strategy advisor and fractional strategy executive working with companies all over HR tech and SaaS, but primarily focused within the HR tech and work tech space and TA tech, obviously. My background is 30 years in the industry. I've had 2 exits of my own. I've advised and worked on a couple dozen more, and I've helped support about $3 to $4 billion of M&A and investment in the space. And so I really focus on making sure companies are ready on both sides, both companies looking to acquire and companies looking to exit, so that the best, most successful decision happens.
Great, thank you. Mark, how about you?
Yeah, hi everyone. Thank you for joining. My name is Mark Simpson. I've spent the last 20 years building software businesses. My first 2 were more in the marketing, tech, commerce, analytics side of things. My first exit was to Oracle back in 2015. I've had 3 sort of significant exits. First one to Oracle, second one was a large actually business to private equity, and the third one was in talent acquisition to a private equity backed strategic. I now do a couple of things. I'm actually under LOI to acquire 2 companies, so I'm now on the other side trying to acquire some businesses. And I do some very selective kind of limited consulting to CEOs around AI go-to-market and exiting. So very good to meet everyone today. I'm looking forward to the conversation.
Great. Thank you, Mark. And AJ.
Yeah, thanks for having me. Really grateful and excited for today's session. My name is AJ. I'm the Chief Corp Dev Officer at a company called Humanly. Previous to Humanly, I built and founded 2 different companies, both in HR tech, both had marquee exits, one being Sprockets and the other being Our Work. So pre-hire ATS and then Our Work on the post-hire side of things. I've done the venture capital thing, and now I am excited to be investing in companies through Humanly, as well as acquiring them as we grow and scale into Series C and Series D. Just to give you an example, in the last, say, 7 months or so, we've acquired 5 companies and anticipate doing even more here in the next calendar year. So I'm excited to chat today and learn from the other speakers as well. Thank you.
Great. Well, as you can see, we have a lot of earned wisdom on the panel, so let's get started. Put 10 executives in the room. 9 will tell you that the overarching goal of an exit is to maximize the cash you walk away with. And obviously that's important. But let's begin by talking about what might be some of the other objectives or goals in making an exit. Sarah, you want to start?
Yeah, I mean, I think obviously most of us are trying to make money, right? We're not building, it's a lot of work to build companies and go through the process on both sides. And so I think the mistake there sometimes is thinking that a higher valuation means you're actually going to walk away with more money, where sometimes, the more investment you take, the less money you walk away in. With a founder. But I think beyond that, it's really looking for what is going to make sense after the acquisition takes place. And I think that's where a lot of deals fall apart. Obviously, like I did a pretty big industry acquisition last year with Smart Recruiters. And as I was looking at the different players in the market, I think for me, one of the things that was really important is what the after was going to make sense. And having the right leadership team that was staying, how it was going to really interact with what SAP and SuccessFactors already had, like having a really clear plan before the decision was made is where I think a lot of companies go wrong. And that's where a lot of acquisitions fail, is they acquire a company and then nobody really knows what to do with it after the fact. I guess that's good for me because that's when I get calls months later, like, oh no. But I think really thinking through, like, what do you want it to look like 6, 12, 18, and 24 months later? I have some of my founders that are still with the company that acquired them 36, 48 months later, and I have others that are gone month 6. And a lot of that depends on finding the right match and what your goals are as you're planning to exit.
AJ, thoughts?
Yeah, I agree with that. And, when I got asked this question, I thought deeply about not only my own situation, but companies that we've been actively acquiring. And I think, a big key focus for me is as a founder and someone who's taken on a lot of venture capital is also maximizing investor returns, not just your own personal wealth. Now, like to Sarah's point, like, yeah, of course we all want to make money, but, I'm Gen Z. And so I have, 5, 6, 7, hopefully new companies that I start in my life, hopefully get bigger and badder every single time. And so when I think about capital, it's not just personal capital in my pocket, it's social capital that you gain over your life via really stressful situations like an exit. And just know that the VCs and the people around you are watching how you react at the very end. And I think, in HR tech, it's not a surprise. There was a funding bubble from 2019 to 2021. So usually as people get to their exit around this time, they usually need to cut themselves out of some cash or their investors. And the way the term sheets all went is usually that's not clear as to who gets what. So just like I always emphasize to founders is just remember, like, if you treat everyone at the table the right way, you do so with integrity at the very end, when things are the hardest, people will remember, you'll establish that trust, and it'll make your next venture, if you decide to do it, materially easier. And to me, that's worth more than any amount of USD.
And AJ, I think I want to add on there. I think that same goes through to the team that helped you get there.
Right.
I see so many people making sure their investors are whole and that they're whole, and then cutting the team last minute, like at the signing table, where people that helped put the deal together, it got shifted and they don't have that job guaranteed anymore, or they're losing equity that they thought they had. And that actually, I think, carries very well in long memories for people on how those things work out.
Mark, what do you think?
Yeah, look, I think of it along three lines, and covers a little bit of what AJ and Sarah said, maybe building on that as well. The first is obviously, the cash side. I mean, as a CEO that's going to be running the exit, you have a fiduciary responsibility to all of your shareholders, and that's kind of the underpinning of everything. But it's not always the headline kind of like number that actually earns everyone the right, the right outcome. There are many details that can go into a term sheet that kind of make that headline number a little bit opaque, let's say, or a little bit less clear cut. Outside of that, I think about what the outcome is for the team and what the legacy is that you want to leave. So, for example, when we sold Pillar to Employ, part of that was the excitement of being able to get a small company in front of 24,000 customers on the one side, and part of it actually was for the team to be the core part of Employ's AI team, the first kind of founding and building of their internal AI team. So it was really a great outcome for the platform and what we built, but it was also a really good outcome for the team, and particularly the engineering team, who can remain with the company and continue to build their careers and build out with a lot more resources behind them. The third side, I think, looking at it from everyone in the room who might be sort of running this, is just looking at, what do you want to do? What's your, what optionality do you want to bring yourselves, or maybe it's core members of your team after the exit? Are you a serial founder, and do you want, things like, do you want to focus on things like, non-competes or short, periods where you have to work for the company, or do you actually want a career within the company that's buying you and run a team within it and do something larger? And it's those sorts of things that need to go through your mind and think about as well. So I think, cash is obviously the one that's spoken about most, but I think there are really kind of three big buckets in the way in which I've thought about the three acquisitions that we've been through.
Okay, now perhaps the most loaded word in the exit process has been used once or twice already, and that's valuation. Obviously, that's important. So, what advice can you give to business leaders about the preparations they should do to optimize the valuation assigned to their company during the process? AJ, you want to start?
It sounded like you wanted to jump in.
No, I was going to say, the only thing I have to say is be realistic. I mean, if you
fine. That's good.
The stuff you see in the news that is like a 30, 40, 60x valuation, that's why they're in the news. I mean, the reality is we're seeing a ton of M&A right now happening in the 2 to 4x valuation with better end, like carry out, than having that high multiple upfront. And I don't think people actually understand or believe that. And so when I'm talking to them, they have very unrealistic expectations of what their valuation is, especially for older tech that isn't AI.
Yeah, I would add to that and say that the world has changed a massive amount in the last 12 months on that. I completely agree with Sarah that like the headlines are the headlines, and you should never believe that the headlines. I think there are a couple of things to think about when if you want to go for that larger valuation, and I'm not talking kind of 60x anymore. I don't think. I think that for most companies, and most companies that aren't growing at 100% plus year on year, that's probably out of the question. There are two things. One is like the core business metrics, that like the obvious stuff. What's your net renewal rates, and do you have client concentration, and all those things where you're just running a really solid business? Are you profitable, and all of those sorts of things? And they should have really run along the lines of how you look at the business and run the business since day one. And they are, under a microscope in front of an acquirer. The second side of things where you can shift the needle quite considerably is how strategic are you to the buyer, and what is their universe of other potential acquisitions that could usurp you or go in instead of you. So, the best outcomes that I've had over the companies that I've sold have been really through creating partnerships beforehand and having those partnerships sort of be successful, so that the acquirer has gone after us and they sort of come in and started the acquisition process. So, I talk to a lot of CEOs about strategic partnerships and opening those conversations as early as you can, in the company's sort of life cycle. And if that is possible, can you be kind of a core part of someone's AI team, or can you be kind of plugging a big gap in someone's product set where they know that their models are going to come out and say, yes, your revenue is X million, but we're going to put it out at sort of 100X million because we've got 500,000 customers, and they can model a really good valuation for you. So there, core business metrics and how strategic are you to the acquirer.
Yeah, and for me too, like what I look for, and if you haven't checked already, Humanly just announced one of our most recent acquisitions on LinkedIn, so a quick Humanly plug there. But what I look for when we're looking at companies is really data moat and revenue momentum, right? So we live in a really strange world here where any kid that basically grew up with an iPad can essentially recreate almost any platform like in a week with AI. Like I remember a year ago when I was like in the thick of acquiring a company called Our Work. Our Work at the time had raised almost $30 million of venture capital and put about 20 into R&D to build a really comprehensive platform. Then I was at YC demo day, and I went to a hackathon that night, and I challenged about a 19-year-old kid on how great AI coding was. And this was before Claude. This was kind of before OpenAI was as successful as it was. He's like, I can recreate this entire platform. I was like, okay, do it. And he did. And, right now with just how easy and not easy, I don't want to say easy because that's degrading, but how efficient building has become, it's really based on like what data you're training on, what systems you have in place to make sure that the AI is doing things equitably, and like the things around the platform that I think companies from, again, the 2019 to 2021 really overly invested in, and now, have the expectation when they get to the exit window that they're going to recoup that money, which it's a really hard conversation, as Sarah and Mark kind of alluded to, of yes, you have invested $30 million into this platform, but you're worth 1/10 that, right? And you invested in, making your horse stronger in the age where Henry Ford was creating the first car. And we need a shift. And I think they're in an interesting cohort of customers that are companies that are going to have continued pain and a little bit of suffering, not to sound so brutal, but in terms of valuation and expectations. But, if you're able to, tell an interesting narrative around what Mark and Sarah said about, making sure that you fit well within the business, that's 1 + 1 = 3. That's of course the best. But I also look for what proprietary data sets do we have that we can use to train our own models and models in the future. And revenue always has a funny way of bucking all trends and momentum. If you're heading in a good way fast, it gets the evaluation up.
AJ, I want to add on something that you said, because I think one of the things that a lot of smaller founders make a mistake of is thinking that going wider and having more is better. And I think one of the things that I'm seeing as I'm going to some of the VC events and looking at some of the founding teams that are coming up and doing just amazing is they've so hyper personalized their offering down to very specific niche. So it's not like they're in healthcare, they're in dentist offices within healthcare, and they're building around that and seeing scaling like we've just never seen before so quickly. And from the acquirer side of things, a lot of times going too wide and adding in more and more features and going into different modules and all of these different areas actually makes you significantly less attractive, because now I'm paying for a bunch of stuff that I don't need. And it's a lot harder to convince my product team that you aren't a competitive solution when I only need to buy this one piece of you. Especially when this is happening from a go-to-market and a messaging perspective, and you don't actually even have this. And so many companies that are sitting in the, I would say, $2 to $20 million range have lost out on acquisition deals, offers, valuations, because they have overbuilt and they're no longer attractive to who would have been their strategic buyer.
The niches are in the riches, or the riches are in the niches, the other way.
It's very true. I actually just put a LinkedIn post up today on this, AJ, as well, in that I would take a serious step back and think about what your company does now that AI can't replicate, and that in there's the value, and matching that up with the right sort of buyer set is kind of the niche where you can get larger sort of valuations. You know, what is it that you do that AI really cannot replicate? Bearing in mind that AI can now replicate quite a significant amount of kind of the SaaS population that's out there.
So stay focused on your core capability, especially that which can't be replicated by our friend AI. Don't have rosy spectacles on when you're thinking about the valuation you're looking for. What other steps in terms of preparation would you suggest that founders or owners consider getting ready for an exit?
We do exit readiness or market alignment indexes, where we're actually looking at how well the internal team is aligned with each other, as well as how well aligned they are with their buyers, with the market. And we kind of come back with an index point, so we know exactly what has to be worked on and where there are gaps internally. And we do this cross-functionally, we do this top to bottom. A lot of people look and just make sure their executive teams are properly aligned. And what I have found over the years is that it's often like the director level and below where that misalignment actually has massive impact on customer satisfaction, on retention, on revenue. And so if we can just clean things up, a lot of times in like a 2 to 8% shift, it is enough to kind of get you over, and you know exactly where your issues are. And I think a lot of founding teams and a lot of companies completely miss understanding why alignment, both internally and with the market, is so vitally important, because they are looking at some of the other metrics and the revenue and these other things, and they're missing the signals of what is about to happen around the corner. And it's things that when we're going through, whether it is exit or investment on the buyer side, that create massive, massive flags for us and actually impact the value.
Anything else, guys?
Mark, you muted, Mark.
You're still muted, Mark.
Can you hear me now?
Yeah,
there you go.
You go. You go.
Sorry about that. I was just saying, AJ, you go if you're about to speak.
No, you're good.
I was just going to add to what Sarah says. I mean, I think suddenly thinking you want to sell your business and then appointing a banker is not the right sort of method of doing this. There's a certain amount of sort of preparedness that you need in advance to exiting. I think of it in a couple of ways. You could either sort of start a couple of years out or 18 months out or whatever it is and start getting the business in shape, or you can start now. The first business I built, which was a marketing tech business called Maximizer, from day one, we said we were going to build the business in the right way that we could potentially list on the stock exchange at some point. And that was kind of like a kind of a view as to like maybe 10 years in the future or whatever it was. And that just got the right discipline in place around the right teams, the right ratios, the right metrics, the right benchmarks to build that company. And it just helped us build the company through time to be very ready when it was actually IBM sort of came in and made the first offer for us. Ultimately, Oracle acquired us. But we were in a good place from that point because we thought about it from day one. Now, you don't have to have thought about it from day one, but you do need to think about it, I think, a couple of years out to get the business in the right shape and do the things that Sarah is saying to make sure that, the business is operating in the right way and the teams are operating in the right way to be ready.
Yeah, mine's a little bit more tactical, I think. I think for me, it's two. It's one is if you're the CEO or the founder of the company, is like build your work days such that it's going to take a lot more time than you think. I've made this mistake now twice out of the 2 exits. I always think it's going to be fast. I always think it's going to be easy. It's never those 2 things going through an exit motion. So you have to align your entire team so that you, who are responsible for selling the company, can stay maniacally focused on the execution of that. Because even if you do have a buyer that's ready to go, there's always diligence requests, your own investors, their investors, customer calls. It's just lions and tigers and bears. And you need to set up your life for about 6 to 9 months to be able to just go through that process. So that's step one. And then 2 is as you start to approach buyers, I'm still approach this as someone who gets probably daily inbound now from founders as to how few people actually have documentation for their business. And Sarah's nodding her head. I'm sure she can help you if you're looking to do that. But I always try to build an executive summary tailored to 25 to 50 prospects that I know would be a good fit for the business. And it sounds intuitive when you're in rooms like this to spend time, research the people that could buy the company, reach out to the right partners and start those processes early. But it's not. And I just humanly, I like to move fast to beat competition because we don't have maybe as big as a bank account as a Workday or ADP, but we can provide certainty and brevity in being able to get a process done. So when we get reached out to by a founder that's, hey, I'm just thinking about selling my business. What do you think? I'm like, all right, cool. Send me an executive summary. Why you feel like this is a good fit? They're like, okay, give me a week to do it. I'm like, well, how serious are you? Like, do you want this process to happen? And if I'm going to devote company's time, nor in looking at you, I would hope that some of that would be reciprocated. And if you do those things, I can in fact move faster. I can in fact pay more, but you can't expect for me to research your company and do everything with just the amount of things that are going on in the space right now.
So what else makes a good buyer? If you were going to counsel a founder or owner on, where to look for a good home for their company, what would you suggest?
Culture fit. Like, it's one thing to have somewhere that your product is going to make sense and fit. And don't tell them where your product fits. They probably know better what they want your product for than what you're trying to pitch them on. But I think the culture side of this and making sure this is where you want your product, your customers, going back to that like long legacy that Mark was talking about earlier, like making the right choice and doing right by your customers and your employees is really, really vital. And that needs to be part of this process as much as looking at financial due diligence.
Yeah, I've gone through what I would class as sort of a successful and unsuccessful sales. And it's not always the ones you think of that are going to be successful. I completely agree, Sarah, on the cultural fit side. And I think that is super, super important. Let me kind of give you kind of examples or underpins. So the first company sold to Oracle. We were part of the Oracle Marketing Cloud, and you think that the company is going to thrive in a larger environment. We did more sales in the last quarter as an independent business that Oracle did in the 2 years afterwards, because they just didn't get their hands around it and it didn't quite work and the cultural fit wasn't quite there. And ultimately, in reflection, it would have been better selling to IBM. So I think just to highlight kind of Sarah's point, cultural fit is super, super important. In the last sale that we did with Pillar to Employ, Pillar has thrived, and there are now kind of thousands and thousands of customers on the Pillar platform. and that has gone really well, and the team are all there, and sort of I think things are making progress. Outside of culture, I would also just look at not just that, but who has the clearest kind of rationale and business plan around it. You know, what are they actually going to do with the business, and get them to be pitching you as to why they're going to take what you've spent years building and take your baby and improve on it. Also, just kind of assess what the likelihood is that they're actually going to get to close, because a lot of deals like start and then fall apart, and it is a massive drain on your resources to go through a buying process and then it not happen, and will set the business back from other things you could be doing and growing on. So just really sort of assessing sort of how good the buyer is and what their reputation is, and their chance of getting it through to actually sort of closing once you've signed that sort of LOI and moving forward.
Yeah, I mean, there's an interesting dynamic when a company gets bought. It's kind of we bought you or you bought us type of mentality that can create an interesting power discussion across the teams, where you want, at least what I look for when I was selling my company, was to join a culture or a team that didn't have the big brother, big sister, little sister type of mentality. It's we got acquired because we feel like we can add value, but we're also here to learn from you as the larger organization. And together, if we work together, we can build a really harmonious integration plan that benefits all. But when you join maybe potentially large organizations that don't feel that way, or culturally they kind of have just they buy a company and don't treat it as such, that's where I feel like you get a lot of integration risk, and it doesn't end up well for really anybody.
We are considerably over our time, and I know you all are busy, but first I'd like to, before I let you go, let me ask, do you have any final thoughts, final suggestions or recommendations that you would leave? As you can see from the chat stream, a very engaged audience. What would be your final counsel to the group? Sarah, you want to go first?
I was just going to remind everybody that as TAtech members, we have partnered with Pete and you guys. And so anybody that is a member that is looking to do an exit readiness or a market alignment, if they're typically within like 6 to 36 months, or if they're even considering this, there is a special kind of package for you guys that we do if you're a TAtech member.
Thank you for that. AJ?
That's awesome. I should have done that, Sarah. So we'll have to do one after. I think for me, it's bringing a certain level of authenticity to the exit motion is really important as the CEO. Like the amount of posturing that I see in materials and presentations, like, yeah, like, of course, we want you to highlight the company's accomplishments and value. However, I think a mistake I see a lot is business owners either avoid, and I don't want to say lie because I don't know if that's the right word, but like kind of throw a lot of things under the rugs where like we're going to find it in diligence, and it's just really uncomfortable when that happens. So being yourself, being authentic, I think goes a long way in the discussions. At the end of the day, you're going to be working with these people for the next 3 years, not just trying to sell your company in 3 months. And establishing that trust early is just absolutely key to getting it done and optimizing your valuation as well.
Yeah, from my side, look, I think we've had a good amount of good discussion here. The one question I would say, I assume everyone's here because they're interested in the topic and they're thinking about exiting at some point. So if that's the case, the one question I think you should leave and ask yourselves is probably, how ready am I for exit? You know, and I think that you've obviously heard a lot of different parts that go into that, but you know, do you have clear financials? Is the business in good shape? Could you provide a clean data room with lots of things? Do you have a plan for what you want to do and the reasons why you want to exit? All of those sorts of things, I think you need to kind of really think about before kind of making any decision or before getting ready. So, you know, the big question I would ask is how ready are you for exit? And that will probably lead on to, you know, many other thoughts afterwards.
Great. Thank you very much. Does anybody in the audience want to raise their hand? Just indicate in the chat stream that you'd like to be recognized, and our producer, the inimitable Stephen O'Donnell, will bring you up on stage, and you can join the conversation.
While we're waiting for that, can I ask a question? I've spoken to a lot of founders over the years, and certainly in the past few years, where they begin their company with the intent to sell it to a particular company or couple of companies. So they build it to sell it within the next 24 months. And that should mean that they're buyer ready from the off. How common is that? And is it really, in contrast to that, the light switch going off 2 years down the line where they think, I should be exiting this company?
I would say it's quite rare. I would say that's quite a high risk strategy as well. I think there are headlines around that, and you kind of read press around that. Quite often, if people are building and they're exiting their company to someone in a year or 2 years, they probably had conversations before they even started the company, and they are building alongside a company specifically to fill holes or to fill gaps. So I think if you're doing that without having had those kind of conversations with companies in the market that you're building towards, I think that's a very, very risky strategy. I think building a healthy business that fills gaps in the market without targeting specific companies is a much more common way of getting to a decent exit.
Yeah, and
I haven't. Sorry, on you go.
No, I was just gonna say, I get that question a lot around just financing. Is people say, how should I build my company to get Series C or Series A and Series B? And like, I can't. A lot of people say, hey, I can't fundraise because I'm in this region or because I'm not in this category. It's like, if you build an awesome business with strong unit economics and proper momentum, like businesses will find you to buy you or fund you. So I think the path of least resistance and the one with the highest probability of success isn't optimizing for exit at like day one. It's set out to build an amazing company, like Mark said, like an IPO type company. And then as you go, understanding the optionality is greater when you have a good company to potentially exit in the future.
So I'll disagree on this a little bit. I think there are some companies where it makes sense to do that. And then I do think there are some companies where coming in and building gap features, especially for the larger vendors, have really high position. Josh just made a comment that it's almost like outsourcing R&D, and it happens, but it isn't reliably bankable. And quite candidly, that's where most of your M&A is happening right now. You just don't hear about it. For every one press release that you hear about, there's probably 20 to 40 acquisitions taking place. I think ServiceNow is a fantastic example of this. Companies like Workday, Oracle, SAP, Microsoft are all doing a large number of acquisitions that you will never hear about because you only hear about the biggest ones, not the ones where they are buying, quite honestly, the R&D. It's significantly cheaper to acquire certain features than it is to try to build them in old architecture. And so it changes the course of how you are coming at it, and if you are building for a specific one. But I think it's somewhere, typically when I see that, it's somebody like, Mark was already acquired by Oracle. While he was there, he noticed this gap. He left, he built this product, and he turns around and sells it right back in. And so that's typically, where you see those type of things happen a little bit more. But those R&D buys are happening far more than I think most people want to acknowledge.
Okay. Well, listen, that was really a great discussion. I want to thank my guests again. You guys were wonderful. Thank you very much. I certainly learned a lot. I suspect everybody at the show learned a lot as well. Just a reminder that if you'd like to participate in another leadership summit of the caliber that you experienced here today, please join us at TAtech North America coming up on May 6th through 8th in historic Charleston. It's going to be a great event. There will be business leaders there from all over North America, of course, but also the EU, Asia Pac, South America. It'll be truly a global gathering of the movers and shakers in talent technology. So please add it to your calendar and join us. We'd love to see you there. Thanks again to you, Sarah, AJ, and Mark. Really appreciate your time today, and I'll look forward to seeing you all again soon. Bye-bye now.